the introduction, and thank you all for attending the webinar today. As mentioned, we're talking about revenue-based financing and how it works for growing tech companies. We'd like to start off, though, with giving a little bit of background on Lighter Capital, as well as a little bit of background on myself, because as an old adage goes, where you stand depends on where you sit. So I'd like you to understand a little bit about my background and Lighter Capital so you understand and give a little context to what we're going to say, because obviously at Lighter Capital we look for particular kinds of companies to fund, and we have our own sort of funding style and mechanism, but we'd like to educate you more broadly on revenue-based financing, so at least you have a bit of perspective. So we lend $50,000 to $1 million in growth capital to growing mostly tech companies. You'll see some of the logos here on the right. There's software, software as a service, tech services, digital media, and the like. We believe this is really an entrepreneur-friendly structure that combines a lot of the best attributes of equity and debt to fund a company's growth. And really from its inception, Lighter Capital, in fact the name Lighter is supposed to be lighter on entrepreneurs, Lighter Capital's goal was to make funding fast and easy. Our real goal is to improve the access to capital for small growing tech companies. So we ourselves use a lot of software to speed up the analysis, the due diligence, and the underwriting process. And we frequently close deals in a month or less. We're currently closing about 3 to 4 deals a month, and on average those are about $250,000, but they range again from $50,000 to $1 million. And all total, we've completed greater than 50 deals. In fact, I believe today we're funding our 58th deal. So far as we know, we're the most active revenue-based lender in the country. So a little bit about myself. I've been the CEO of Lighter Capital since 2002, and really since I graduated from business school in 1999, I've spent my entire career essentially on one side or the other side of the table of small business financing, all for tech companies. So in my past, I was a CFO and director of a publicly traded technology company, energy tech company, where we raised a whole bunch of money. And earlier than that, I was actually a VC for 5+ years at a firm called Summit Energy Ventures, focused on mostly clean tech investments and such. And I've been quite active as an angel investor in 8 different angel groups and investing groups. And earlier than that was an entrepreneur at various tech startups. So always pretty much spending my life raising money, building companies, and investing money in various types of form, everything from sort of venture preferred stock to convertible debts to pipes to lines of credit and all kinds of things. So today's real agenda, we're going to talk a little bit about what exactly is revenue-based finance, how it's structured, who it really works and is designed for, and where it really fits in the mix of different kinds of financing sources. And primarily those are banks, angels, and VCs. So really first, how does it work? As I mentioned, we provide up to $1 million, but the other limitation is we can't provide a company that's a startup, for example, with $1 million. At most, we provide, and we think most RBF, as we've called revenue-based finance lenders, provide up to about 1/3 of a company's annualized revenue. So if you've got $25,000 in revenue a month, you've got $300,000 in annualized revenue, we can give you $100,000. There's really no set interest rate, payment, or maturity with a revenue-based loan, which is a little bit odd. Most loans obviously have a set payment, set interest rate, a set maturity. So right out of the gate, revenue loans really kind of bust the mold of what normally a loan is. That's a lot of the ways that they mimic equity. Monthly payments are not set, but they are set as a fixed percentage of a company's revenue. Typically, we see percentages somewhere between 2% and 8%, but it really varies all over the place, and it depends upon the size of the loan compared to the size of the company and a variety of other factors. We structure our financing so they mature in 5 years, but the real maturity, the real termination of the loan actually occurs when the total cumulative payments, these sort of varied payments over time, when those total cumulative payments equal a certain dollar amount. That dollar amount is set at the beginning of the loan. That dollar amount usually is somewhere between 1.5 to 2.5 times the principal amount. So down below we've got an example loan. Company doing about $1 million in revenue, and we fund companies that are doing anywhere from $200K to $10 million or so in revenue. But in this example, this company is doing $1 million in revenue. They want a loan for $200,000. It matures in 5 years. They're going to pay 5% of their monthly revenue, no matter how much that monthly revenue is. Literally, if they get 0 in monthly revenue, they make a payment of 0. And they're going to pay that amount until they paid 1.75 times the principal amount. In other words, $350,000. So that's really targeted to be paid over 5 years. But as I mentioned, the loan really terminates whenever they've paid that full repayment amount. If the company grows really, really quickly, maybe they'll pay it off in 3.5 years. If they grow much more slowly, it may take a lot longer than 5. But as an investor in revenue-based loans, as sort of an investment lender, as we consider ourselves, really our risk is that it will take a lot longer, and essentially that means our return goes down. If the company grows really quickly, then our return goes up. That's where we sort of see that there's aligned interests, which we'll get into later in the presentation. We also take a small upside participation. For those of you that are familiar with early stage company debt or venture debt often comes with a warrant, which is the right to purchase stock. We actually don't do that. We structure it differently. And it's a little bit complex. We won't get into it here. But we typically have some sort of upside participation if the company is sold, if there's a liquidity event. So this graphic really just sort of shows how these payments are structured, and sort of to try and sort of nail home that this is really a variable payment loan. So as your revenue goes up and down, the payments go up and down. And that's exactly also how an investor in a revenue-based loan, how their interests are really aligned with the entrepreneur. In other words, the entrepreneur wants to grow his or her business, and frankly, so does the revenue-based investor want the entrepreneur to grow his or her business. They really want those payments to grow, just like the entrepreneur wants the revenue to grow. So in a lot of ways, we believe that although no financing structure is perfect, and all financing, all capital has a certain amount of cost, we really started the firm because we believe that revenue-based financing combines a lot of the best aspects of equity and debt. As opposed to a lot of typical loans or lines of credit, there are no financial covenants. So typically you might see in a line of credit or a loan that the company can't lose more than a certain amount of, have a certain net income loss per month or per quarter or per year, or they have to have a certain number of months per year of profitability, or they have to hit certain milestones. We don't have any of those types of covenants at all. If a company, like I said, has 0 revenue, they make 0 payments. If their revenue grows hugely, then obviously the opposite. So we consider to be no loss of control also. As opposed to VCs or other equity investors, we don't take a board seat. We don't have any right to replace management. We also don't have any right to force a sale of the company or to prevent, really essentially, a sale of the company. That's all really left up to management to do. And as opposed to a loan that you get from a bank that really is based mostly on the FICO score of the entrepreneur and the personal assets of the entrepreneur, we don't look at that really much at all. We really are betting on the business. We don't bet on the being able to go after the home of the entrepreneur. That's, in fact, kind of anathema to our entire sort of philosophy on why we're investing. And as I said, our interests are really aligned. Our ROI, our IRR, and our loan, our returns totally depend on the performance of the business. So we're naturally there to help. In fact, we frequently are talking to entrepreneurs and explain that we essentially are kind of VC light. Our interactions with the entrepreneurs and the companies are really sort of halfway between a bank, which is relatively passive and just wants to make sure they collect their payments, and a VC that is, a full partner in the business, going to board meetings and has a lot of control. We're sort of halfway in between. We're there to be helpful, and if we are helpful, then it actually directly helps our returns. But we don't have any actual control, and we don't have to be helpful. The entrepreneur kind of dials our help up when they need it. So broadly, our investment criteria, we're focused on relatively early stage companies compared to a lot of revenue-based financing firms. So if you talk to a lot of the other firms out there, you may see that they're significantly kind of upmarket from us, but we'd like to tell you what ours are so you get, again, sort of a sense of perspective on who's talking to you. So we look for companies that are doing at least about $200,000 in annualized revenue, about $15,000 a month in revenue. We look for companies that have really high gross margins. Typically, we're investing in a lot of software or tech services companies that have really healthy margins, 50% or plus. Profitability is not at all required, but we do not like to take on a lot of financing risk. So we typically don't provide a loan to a company for, say, $200,000 if they're burning $100,000 a month. We want our capital to be able to get the company through to viability. And if they want to take on further financing past that, we want that to be a choice, not something they have to do or they die. We prefer not to have too much debt on the business, other debt on the business, really. We often work very closely with banks and bring in lines of credit because that'll help the company grow, which is obviously in our interest. But we don't like to have tons of other debt out there, just because it ends up being too much of a load on the company. Convertible debt is certainly a bit of an exception to this. We really see convertible debt as essentially unpriced equity. And so convertible debt is a great exception to that other debt prohibition. We really like to see a diversification of customers as well. Since obviously as a lender, we really fear in some ways loss of our capital, and our upside is very much limited compared to an equity investor. So we really don't want to see the company be in peril if they lose one customer that might be 80% of their sales. And in small companies, often that's the case. We really love recurring revenue models, thus the sort of focus on SaaS, long-term contracts, and things like that we love to see. So we love to see that the business is going to be relatively repeatable, relatively consistent. We also love to work with entrepreneurs who own a huge portion of their company. We don't ask them to be all in terms of putting their house on the line with a personal guarantee or anything like that, but we want them to certainly feel like they're fully dedicated and feel all in terms of the fact that they have a huge upside in the equity ownership of the company. In fact, really one of the greatest benefits of a revenue-based loan is it's essentially a substitute for selling equity. We really want the entrepreneur to control and maintain as much of that equity long-term as possible. We currently are limited to financing businesses based in the U.S. and Canada, and we really want entrepreneurs to use the money for growth. We don't want to be taking out existing debt. We'll do a bit of that, but we want the majority of our funds to go primarily for sales, marketing, product development, product launches. We most frequently are funding hiring salespeople, hiring a VP of sales, or hiring a big marketing spend and push to help the company kind of go from the stage it's at today to the next level. As I mentioned earlier, we have a relatively expedited process because that was really the goal of Lighter Capital was set out, was to use software and to use this structure to be able to be lighter on entrepreneurs and fund them quickly. So we really, if you go to our website and look, you'll see that there's an initial application. It's a really simple 2-page web form. It kind of gives us this company snapshot. It really should be something that an entrepreneur can fill out in about 10 minutes. From there, we'll get on the phone and start talking. We'll find out more. And then from there on out, if it seems like it's a fit, the entrepreneur goes through a bunch more software. We integrate with QuickBooks Online and all kinds of other sources to pull the data in a highly automated fashion in a way that we think is really easier for the entrepreneur. So instead of going through a traditional due diligence process with a VC or a bank or angels where you're sending out all kinds of Excel files and documents and things like that, we really try to collect that information in as automated a fashion as possible so the entrepreneur can focus on their business. And then a lot of the other RBF funds try to do that as well, as much as possible. Then closing the deal, typically we issue a term sheet. We actually do that all online as well. And once it's done, typically we go for about 2 weeks from term sheet to completed deal. As a general rule, 18% of the companies that meet our criteria on the prior page, we actually end up funding. So it's actually an incredibly high fund rate. When you compare that to VCs and things like that, you commonly hear we'll fund about 1 in every 100 companies that they really come into contact with. We actually fund a dramatically larger portion. That's frankly one of the benefits of this structure. It's a lot easier to find a funding fit with companies. Here are a couple of companies, just quick case studies of a couple of companies that we funded in the past. Valent on the right was one of the first companies that Lighter Capital funded many years ago. The company has grown tremendously. We provided them a $250,000 loan for product development, sales, and marketing. They have grown absolutely tremendously, and they just recently raised $11 million from a private equity source that we helped introduce them to. But during the term of the loan's now been fully repaid. During the term of the loan, their revenue grew more than 10x. It was an absolutely incredible job. The entrepreneur did an incredible job and really used relatively scarce resources to build it. On the left is CloudBuilt. It's still a company that's still in repayment with us. We funded them back in 2012. They're also a great success story. We've done multiple rounds of financing to CloudBuilt, which is quite frankly something we frequently do. We very, very frequently fund a company on, say, day one, and then 4 months later, 6 months later, 12 months later, provide them further rounds of financing. So in the case of Valent, I should say, we only did one round, $250,000. In the case of CloudBuilt, we did 4 different rounds of financing over about an 18-month period of time. All total was $1 million. And that was really basically at the entrepreneur's desires. They would call us up and say, hey guys, we're ready to take it to the next level. Can we have another $250,000? Anyway, through our money and the entrepreneur's own money, they have done extremely well and were recently named number 227 on the Inc. 500 fastest growing private companies in the U.S. And actually out of that list, everything in the economy is on that list. So on that list, they were actually number 15 in the software category. It's really, truly incredible growth. So how, as a company or as a legal counsel to a company, would you decide if revenue-based financing is a good fit? So obviously, every sort of financing source has particularly good fits and bad fits. So we look really broadly at the economy and at angel investing and the number of small software companies out there. There are roughly 6 million small businesses in the country. There are 127,000 or so small software companies. Now, out of that, every year, there are several thousand angel deals and about 1,000 VC deals. You can find different kind of data all over the place, but the overall message here is that really, although if you read TechCrunch and VentureBeat and things like that, it sure seems like anybody that starts coding some software gets a pile of VC funding. In reality, it's pretty difficult to go out and get a lot of angel money or VC money, and it really takes a lot of time and effort. You have to fit a certain kind of profile. So what we believe really is there are a lot of different kind of roadmaps you can go on. It really depends on what you want the purpose of the money to be and where your business is. So as we like to say, sort of what do you want to be when you grow up to that next stage? The 2 main things are know your business and know your goals. And things to keep in mind whenever you're choosing any sort of financing source is go after a source that's actually available to you. We see a lot of entrepreneurs that head down dead ends because they don't understand that, say, a bank isn't going to fund them in the way that they think a bank is going to fund them, or that a VC is not going to be interested necessarily in their company for X, Y, or Z reasons. And they spend a lot of time running around after basically dead ends. That can waste a huge amount of time, energy, and enthusiasm. The second thing to really think about is financing decisions are hard to reverse. Any sort of financing partner comes in for a period of time and they expect to be somewhat of a partner with you, whether it's a bank or whether it's a VC, anything along that spectrum. They expect to be with you for a while, and if you suddenly want to change course, it can be moderately painful to extremely painful. So choose wisely. So the first of those 2 things is know your business. The second one, know your goals. The first aspect of know your business really is know what the financing is going to do for you. It's really the summary of this slide. So where are you and where do you want to get to with the financing is really the first bullet point. Next one is how much money is it really going to take to get you there? And that's a huge question. And we run into a lot of entrepreneurs, and we spend all day long talking to entrepreneurs. We spend a lot of time talking to entrepreneurs that don't really know exactly how much money they want, how far it's going to get them, which is totally fair. Building small businesses is difficult. You don't always know that. But if you don't know for sure or you don't feel that certain about it, oftentimes it's better to take slightly less money and kind of grow with it, which actually for us is one of the reasons why we do multiple rounds of financing. Also, you really need to think through what your existing investors want. For example, if you've got VC investors in the deal, well, VC investors expect certain things. They expect they're going to have a return of their investment through an exit of some sort within a certain number of years. If you've got friends and family that are investors in the business, what are their needs going to be? When do they need that money back that they gave you? So you need to think through that. Then on sales and marketing, since primarily from our perspective we're funding growth, we really focus a lot on what's the company going to do with the money and how's it going to work. And frankly, almost all providers of growth capital, whether it's a VC or an angel or us, they're really going to wonder, what are you doing with the money and how's it going to impact the company and how are you going to take it to the next stage? So the major questions there are really, do you know your target customer? Do you know where they are? Do you know how to get in front of them? Do you know how big your market is? For example, there's sort of a line. If you've got a market larger than $1 billion, a lot of VCs may be interested. If you've got a market that's smaller than $1 billion, it's relatively difficult to find VCs who are interested because they really want to see you have a big market opportunity. And the second thing is really the mechanics. Are you ready to scale? Have you found that sort of magical product market fit where you know that if you pile a certain amount of dollars into the business and into the customer acquisition effort, that you're going to get a certain amount out of the business. So nailing that cost of customer acquisition, what the lifetime value of the customer is, and then what's the churn rate. So every year you're going to lose and retain a certain percentage of the customers. Do you really know what that is, and do you know how to sort of dial that in? The more you know about that, the more you'll be able to fine-tune your fundraising strategy. And the last thing is really, is your team capable of going to the next stage? A lot of small businesses go through hiring different people at different times. And when you're going from one stage to the next stage, a lot of times a team that can go from the earlier stages isn't necessarily the team that's going to go to the next stage. So what team do you have? Are they capable of going to the next stage? What gaps do you have to fill? And how are you going to do it? And frankly, a lot of times funding is coming in to help you fill those gaps. So you don't have to have it perfect before you get financing, but you have to know what you're going to do. All right, knowing your goals. These are really personal preferences in a lot of ways and how you want to grow up your business. But one of the first questions is, what's really your long-term goal for the business? We talk to a lot of entrepreneurs who really think they never want to sell the business. We talk to other entrepreneurs who are very clear that they want to sell in the next 2 to 3 years. You see everything in between, obviously. But really knowing what your goal is going to make a big difference about what kind of funding path you want to go down. If you want to sell the business in a year, it's probably going to be kind of difficult to get long-term growth capital out of somebody, because long-term growth capital wants to be long-term. If you want to sell in a year, you can probably go get a bank to finance it, though. They don't particularly care nearly as much. Control is a huge sticking point with a lot of entrepreneurs. So who do you really want as partners, and how do you want that partner to be a partner with a small p or a capital P? So we, for example, consider ourselves to be a partner with a small p, whereas a VC is really a partner with a capital P. So who controls big decisions, like when you sell? Is a minority shareholder going to be able to prevent you from being able to sell, or will they insist that you sell? So how is that control structured and shared? Those are some really important questions, and a lot of entrepreneurs are completely accepting the fact they're going to share control. Some entrepreneurs, completely not. All kinds of variations on the spectrum there. Equity, of course, and dilution is totally a question of what are you willing to give up in terms of your sort of economic upside. The time frame, like I said, can make a huge difference as well. You know, some businesses are at a point where the entrepreneur can take off and go fundraise for 6 months. Your typical VC deal is pretty much the entrepreneur is going to have a full-time job for 6 months. If you have that kind of time to dedicate to it, then you can do that. If you feel like doing that is going to detract from the ability to build the business, then that's going to be hard. You really need to think through, okay, what kind of financing sources are available to me if I only have limited time, or if I want to stay focused on the business. And of course, what are you willing to risk? Again, a personal guarantee on your home. Some entrepreneurs say it's totally acceptable, some not. Some want to put their money into their business, some don't. The other one is flexibility on how you repay. If you're a loan, whether it's a loan like a bank or like a revenue-based financer like us, you're going to have some sort of payment going out of the company. Equity, of course, you basically pay upon exit of the company when you sell it. So totally different. Do you want some mentoring and some guidance as well? Makes a big difference. Banks tend to obviously provide very little of that. We provide some of that, like VC Lite. VCs are going to provide much more of that. And how aligned can you get the investor's goals with yours? It's never perfect. There's no perfect solution to exactly align investors' goals with your goals, probably. But you've got to try and make it as clean and directly aligned as possible. All right, this slide shows where different funding sources fit into the different growth stages of businesses. Now, this is a great sort of generalization, and there are certainly exceptions to this. But the goal is to sort of show you a broad perspective on where different financing sources will come in and be available to you, as well as obviously where revenue-based financing fits in. So at the really early stages, you've got bootstrapping and family and friends and angels incubators and things like that really come in. So everything from Techstars, Y Combinators to a rich Uncle Bob to money out of your own bank account. This is typically the way a lot of companies get started. Coming out of that, sometimes when you have an initial product, there's some seed VC funds that will come into businesses there. A lot of times it's entrepreneurs that are relatively well proven, have maybe done it before. It's harder for entrepreneurs that are not as well proven. or don't have sort of a good pedigree to get funded at earlier stages. So a lot of times you end up sort of financing through other means. Revenue-based financing sort of comes in next, where you have, for example, with us, at least $200,000 in annualized revenue, $15,000 a month. A lot of the other revenue-based financing firms are a little farther up market, like I mentioned earlier. So they're really looking at companies that are more in that established category, and they're looking mostly to cut checks that are somewhere between $3 and $10 million to companies that are doing 10+ million in revenue. Strategic investors are really all over the place. You can get strategic investors in sometimes much later, obviously, is where they frequently come in, but sometimes they'll come in a bit earlier. And then banks. If you've got personal assets, you can often get a loan against your personal assets, basically based on your own credit, at an earlier stage. But what we put in here was banks who will come in and provide you financing when you don't have a VC. Sometimes banks come earlier with a VC. So what we've shown here is banks who will fund you when you don't have a VC and when you're not willing to put up a personal guarantee. Typically, especially for software and services type companies, tech companies that we're focused on, typically the earliest banks will come in is when you're hitting 5 million or so in revenue. That's often kind of a shocker to companies, but it's really where a lot of the tech banks, that's the earliest they'll come in. All right, another summary of sort of how some of the different options compare and where revenue-based finance fits in with some of the more common forms of bank and venture. This is a summary. I don't want to go through every single one of these slides. I'll just sort of highlight some of the different ones we've covered. But essentially with a bank, some of the control issues are going to be mostly around financial covenants, and with some of the non-tech banks in particular, you're going to have some personal guarantee types of issues that you have to figure out whether you're really willing to accept. With revenue-based financing, you have very little financial covenants and no personal guarantees. So that's relatively easy. And with venture capital, they're really a partner in the business. They're going to have some controls over different actions you take through the preferred stock that they use as an investment vehicle, and they're going to sit on your board, so they're going to make a lot of the important decisions with you. But obviously, you're not going to have a lot of financial covenants like you would with a bank. What's the different value add? We already sort of touched on, obviously, the sort of spectrum from bank on the low side to VC on the high side and RBF investors somewhere in the middle. Dilution really goes from low to high, going from a bank to VC as well. And then payment flexibility is really going also from low to high. A bank's really got pretty much a fixed set of payments, or if you've got a line, they got a fixed interest rate and fixed payments. So if your business is doing well or not doing well, you're basically making that same payment. With the revenue-based financing, obviously, it's designed to be very variable with your business, growing and shrinking with your business as your business ebbs and flows. And then VC, obviously, you're not making any payments, or angel investors. Those are, even with convertible debt, typically there's no payment being made, and those are equity investors. So you're going to just pay them, hopefully for them, a much bigger check at the end, but no payments along the way. And then what's the speed factor, the timeline? Banks can react in all different kinds of time frames. But typically for a deal like we spec'd out above, where there's no personal guarantee and where there's no VC involved in the deal, what we typically see is 4 to 8 months. 6 months or so is pretty common, depending upon what kind of other debt you've got and the financial performance of the business. With revenue-based finance for us, like I said, we typically close deals in about a month or so, but there's a very big variation. We'll go in as little as 2 weeks if something's relatively easy and clean and straightforward. Sometimes it takes 2 months if there's a lot of other debt or other issues we have to work through. VC is also highly variable. A lot of times you'll read stories on TechCrunch about how some fund or some firm got funded and really quickly by walking into Sequoia's offices and walking out with a check, it seemed. But more typically, it takes a lot longer than that. Those tend to be companies that are sort of shooting to the moon. And even if you're growing quickly, it'll still take you a long time to really find the right match for you and your business. Because VCs are really selective on who they work with. And it doesn't mean to say if a VC says no to you that you're not great. It just means that maybe you don't fit quite the profile they want for one reason or another. Overall, you should expect it's going to be at least 3 to 6 months. And that brings us to sort of the end. We're ready for different questions. And I'll hand it back to Patrick a little bit to go through some of those questions.
Okay, thanks, BJ. So feel free to put your questions in. We've got a little bit of time to go through a few of them, so ask away, and hopefully we'll get them answered before we close out today. So we had a few questions which sort of relate specifically to some of the qualifying points for a revenue loan or revenue-based financing for us. The first one is the $15,000 per month revenue minimum a hard minimum?
And let me go back. I'll just go back to that slide so everybody sees the actual data that we had here. Just remind them of it. The 15,000 is a relatively hard minimum for us, yes. The way our fund is structured, we need to see that the company has revenue and has an expectation of continued revenue, since that's really the mechanism through which we get repaid, is through that revenue. So the 15,000 per month is a relatively strict criteria for us. That said, we really love to talk to companies and entrepreneurs that are earlier stage than that. We routinely talk to companies that are well below 10,000 in revenue or just getting started out, just to educate them a little bit on what we do and when they would qualify for financing with us, and then also just referring them off to other financing sources that might be more applicable for them now. So, you know, we obviously we're playing in the financing game, and we know lots of different financing sources, so we try to be as helpful as possible, and we'd love to talk to people who are early. So don't hesitate to contact us if you're before that, but in terms of getting financing from us, yes, it's a pretty strict minimum.
And do you base that on sort of an annual revenue number when you're working out the loan amount, or the recognized monthly revenue?
We annualize it and then look for the fund amount. Or you can look at it two different ways. Essentially, it's somewhat the same thing, just different math. If you've got, say, $25,000 a month in revenue, we look at that and say you're at about a $300,000 run rate, annual run rate. And we can provide you 1/3 of that run rate, so $100,000. Or the other way to work the math is to simply say, hey, what's roughly my average revenue today? Say it's $25,000. We can provide you roughly 4 months worth of that run rate of revenue. So again, about $100,000. It's
accumulated payments, I think this is going over sort of paying out the loan, haven't met the original principal after 5 years. Is the balance of the principal due at the end of 5 years?
In our loan, the balance of the principal is due at the end of 5 years. So theoretically, if you hit 5 years and you haven't paid that, in the example we had here was in the bottom half of the slide that's showing now. For example, this company owed 1.75 times the principal amount, the $350K. If you haven't paid that total amount back after 5 years, then yes, you hit a maturity date, and technically the full remaining amount that's owed under the loan is owed on that date. That being said, I mean, that's where the legal docs are written and such. That being said, obviously it really depends on what's going on with the company and how it's going to work. When we hit those maturity dates, our goal is to really work with the company to make sure something works well for them and works well for us. But technically, legally in the documents, yes, the full amount is owed then.
Okay. And just, I guess, continuing on the payout theme, are there any penalties for paying the loan out early?
There are no penalties for paying the loan out early. However, keep in mind that there's a total amount owed under the loan. So there's really technically not much incentive to pay the loan out early. So again, in this example loan we have up here on the screen, though 1.75 times the principal amount is what's totally owed, you can pay that amount anytime you want, but there's not much incentive to do that. So there's actually sort of two answers to this question. One answer is the one I just gave, which is really the way the legal documents work, which is you owe that full 1.75 amount. That said, also, we do routinely work with companies if they are anticipating some sort of event to happen in the business. For example, if we fund them January 1 of 2015, and they're expecting that they're in negotiations to sell the business or something like that, we'll try to structure something with them so that the return to us is both healthy and reasonable, and yet is not ridiculous. And we really our goal is to be paid out over a number of years. And if some event's going to happen that the company can easily foresee that's nearer term than that, then we'll try to structure something in that loan where there's a reduced payment for it happening at an earlier date if that event comes to fruition.
Does the loan show up as debt on the balance sheet, on their balance sheet?
It does. And we frequently get questions about should the company show, for example, in this example loan, when we fund it, should the company show $200,000 in loan or $350,000 in loan? It's $200,000. Just like you would have, let's say you had a 5-year term loan from a bank at 10% or something, you would show $200,000 of the principal. And just like a bank, every month you get a statement from us that says you made a payment of X thousand dollars last month. Out of that X thousand dollars, a certain amount of that went to principal, a certain amount that went to interest, and therefore at the end of the month after that payment, there's some lesser amount of principal still outstanding, and you just put that into your accounting just like you would a normal loan.
You indicated that you work with banks frequently. Are you subordinated to them in debt and collateral, or just lien position, and are you still able to collect your payment?
Yes, we always subordinate to a bank. We have standing subordination agreements with some of the major tech banks, and we work with them quite a bit to bring them in. So we are always subordinated. We still get paid, so long as there's no defaults and things like that that the bank is calling us. So as long as there are no problems, we still get paid every month and such while our loan is outstanding. And as does the bank, they get paid on their loan, of course. But basically, if something if a downturn happens, if something bad happens, the bank is going to be senior to us, and they'll get paid out first in a liquidity event or liquidation or anything like that. They're going to be senior to us. And let me expand upon that a little bit, because this is sort of an interesting point for debt. A lot of debt providers do not want other debt on the company. We're a little different than that, because the faster the company grows, the better we do in our returns. And so we want you to have as much liquidity and capital as you think is beneficial to help you grow the company. So if that means that, let's say we fund a company when they're doing $2 million in revenue, and when they grow for a year or two, and they get to $4 or $5 million in revenue, where they can go to a Silicon Valley bank or Comerica or someone like that, and they can get a line of credit and bring in another $500,000 worth of financing, it's absolutely in our interest to help the company do that, because it's going to provide them more capital to grow, and frankly, bank debt is going to be cheaper than our debt. So that's helping the company sort of ratchet down their cost of capital, helping them grow, helping them to be healthier for the long term, and sustainable growth of the business, and ultimately that leads to a better return for us. So we see ourselves as sort of in that very middle position between debt and equity, and so we frequently subordinate to banks.
How do you determine the payment cap, the 1.5 to 2.5?
Yes, there are a variety of different factors that go into the two major components of a loan. The two major components of a loan are the percentage of revenue that is the payment. The other major component is the cap, the multiple of the principal amount that is the total amount owed. There are a couple different factors that go into it. One factor is that you can kind of play those two factors against each other. Think of them as a little bit like a seesaw. If you as an entrepreneur are really focused on having a low payment today, then you could negotiate with us and say, I really want a low payment. I really want to take that loan down from 5% to a 4% of revenue as the payment. In that case, we'll probably increase the cap a little bit, so increase the total amount of dollars you owe, but decrease the payment. So the loan's probably going to be a little longer term. Or the reverse happens as well. A lot of entrepreneurs say, well, geez, I don't want to owe $350,000 total, so can we reduce the cap, and I'm happy to increase the percentage of monthly revenue. So number one factor is you can play those off against each other a little bit. The number two factor is that we typically, on average, we propose to companies that they pay us 2x, but it really varies quite a bit. On smaller loans, like $100,000 or so, we typically are doing 2x is about the minimum cap, just because, in essence, we do a lot of the same work for a $100,000 loan that we do for a $500,000 loan. And so we need to get a certain total dollar amount to actually make an amount on the loan that sort of covers our costs and all kinds of things like that. On the larger loans, we can tend to be a little bit more flexible and have a little bit lower cap. But it really mostly depends on the entrepreneur. So summing up, there are a couple different factors. Number one, you can sort of play the percentage of monthly revenue off against the cap, kind of like a seesaw. Number two, for larger loans, we can be a little bit more flexible. And so our third one is it really depends a little bit on the risk profile of the business, the growth, the risk profile, and a variety of different factors, lots of different things that go into that, everything from the stickiness of the revenue to other factors. But generally speaking, we, as an investor in revenue-based loans, are happy to work with an entrepreneur to structure a loan that works for them. So we're happy to sort of go within a certain particular range for that company. It's not always 1.5 to 2.5. Sometimes most of the time it's a much more narrow range than that. But the range is relatively wide. So we can structure something that works for them and works for us.
Okay. What for the upside participation? What is the vehicle for the upside? Warrants, options?
Yes. The reason why I skipped over that a little bit, it's a little bit complex, but you're going to ask, I'll go into the details a little bit. So the entire mantra really with Lighter Capital is we want to allow the entrepreneur to own as much of the equity side of the company as possible, and we want them to feel completely in control. If we owned a warrant or an option or something like that to buy stock, a warrant is basically the right to buy stock at a particular price, then that means that we really have the right to own shares. And that's kind of against our philosophy. Our philosophy is leave the equity in the entrepreneur's hands and provide them capital in a way that therefore works for them and works for us. So the way we structure the upside participation is a bit unique. We typically structure it one of two ways. We either do what we call a success fee, which means if there's a liquidity event, we get a certain percentage of that liquidity event. It's usually quite small. Or we have a success cap, which means basically if there's a liquidity event, then we get a sort of a multiple, sort of like a smaller extra cap on the loan. So if there's a liquidity event, we may get, in this example here, this $200,000 loan, we may get another $50,000, like I said here. In other words, 0.25 of the principal amount, 25% of the principal amount we'd get as at the liquidity event as an extra sort of upside participation. Let me be clear also on one other aspect of that upside participation. There's a limited lifetime on that. So that upside participation evaporates entirely after 5 years or 2 years after the loan is repaid. So our entire goal is to say, hey, listen, we deserve, as an investor taking risk, we deserve some upside participation, kind of like a lot of debt investors do, kind of like a warrant. We deserve some upside participation if it happens, roughly in the time frame of our loan, and we help contribute to that. Our capital helps contribute to that. But if you sell, 4 or 5 years after you've already repaid our loan, obviously, we didn't really have that much to do with it, and we don't believe we deserve that much of it. So our upside participations are structured to completely expire.
Would you help a company find a strategic partner? For example, one of the different companies that you invested in the past.
A strategic partner can mean lots of different things. Sometimes that's sort of a euphemism for being acquired. Sometimes that's just a partner to help build deal flow or to do some sort of mutually beneficial technical integration. And no matter which one of those is the person asking intends, the overall answer is yes. We will certainly help with that. Right now, working with one of the companies that we funded who is interested in finding a strategic partner sort of anywhere along that spectrum. And so helping them think through what kind of target type of company would be good for them to work with, as well as making introductions to any companies that we know that are in that space. We are not an investment bank, so we do not specialize in doing that, but we certainly are there to help, and we will certainly help make any introductions we can. They're going to be helpful, and we'll also kind of help counsel you a little bit on like what do we think is reasonable, what do we see in the market for funding or for acquisitions or for kind of partnerships and such. We'll kind of basically help you with whatever information and help we can. That being said, obviously the core of our business is not buying and selling companies or lining up those partnerships on a repeated basis. So we also have some different investment banks and things like that that we know that we'll also introduce you to in case you want to work with them. But basically, we'll help. But we're going to be one of the people that will help you out, I think, in that.
There's kind of a follow-on from that, BJ. It's like, to what extent can you help on, say, high-level marketing or sort of more general strategic advice?
It really depends a lot. We try to be as helpful as possible. Patrick himself even gets on the phone sometimes with entrepreneurs and helps sort of guide through and give them help with whatever he can help with or connections that he has. Recently, we were talking to one of actually the companies that already repaid us that Patrick could maybe help out a little bit because he knows some different agencies they might want to hook up with and has probably had more time dealing with them than perhaps the entrepreneur has. So we certainly do that. Keep in mind, though, a little bit, too, that we are very agnostic as to what industry you as the entrepreneur are trying to sell into. So we like to fund companies that are in SaaS, software, technical services, and things like that. That's really our chosen field. But we don't specialize, say, in healthcare or in consumer packaged goods or anything like that. And so we may know some people in your chosen target industry, but we may not. Where we do, we are absolutely more than happy to be helpful. I mean, that's what we consider ourselves to be sort of VC light. But we are not specialists in any particular sector. And in that vein, we're kind of like a lot of different VCs, but not like others. There's some VCs that really focus in a particular sector and know it really well, and they tend to be much more helpful with sort of revenue-generating connections. There are other VCs that are more broadly sort of software and IT focused, and they can be helpful somewhat, kind of like us, but they are not necessarily deep domain experts.
Okay, we've probably got time for just a couple more questions. I've got a couple of questions here from obviously people who are outside the USA or Canada, but looking to expand into the US and Canada. In what ways or how might they kind of get access to a revenue loan from Lighter Capital? Is that possible, or what would they need to do?
Yes, we really want to see a couple things. We really want to see that the business has some significant assets in the U.S. And by assets, really mean some really firm commitments and some important things to the business. We don't necessarily mean assets like hard assets. Most of the businesses we fund don't really have hard assets, frankly, but that they've got a significant sort of investment in the U.S. in some sort of way, shape, or form, and maybe have like a good, very healthy portion of their revenue in the U.S. That is particularly important to us. If that's the situation, we can sometimes work with companies to structure a loan, but really we will be loaning essentially a U.S. entity that money. So if you've got a U.S. entity that's formed and that holds a lot of your assets or a lot of your revenue goes through, then that's something we can certainly look at and try and figure out whether we can structure it. It's certainly worth a conversation. If you have no presence in the U.S. at all, but you kind of want to come in, then you're probably going to have to make some of those moves, like forming an entity here and having a bunch of revenue here and things like that, before we're going to be able to fund you.
And just one last question: in terms of the funding process and applying for funding, what are the main tips in terms of the types of information we want to see, how we want to see it? What makes the process go smoothly?
We want to know everything. No. What makes the process go most smoothly is having your, I should say this, we want to see some of the same things that any investor or lender is going to see. That's really the bulk of things. We do it in a much more tech-enabled manner than a lot of lenders do, but the bulk of that list essentially is solid historical financial information, information on your major customers, information on your offerings, your products, your services, how they work, how you collect money from people, how you bill people, what your relationship with those customers is, as much as we can understand about sort of how you retain or churn through customers. We're going to really focus on what your plans for the use of the money is, what existing debt you have, since obviously we're debt, we have to figure out how we sort of fit into your capital stack. Those are really the main things that we want to know. And then what do you expect to do sort of with the business, what are your goals? Since we really want to be funding people that are very much aligned with how our funding fits. So we make sure we're a fit for them. And that happens through our software and through the phone, and then sometimes, of course, through email and sometimes mailing Excel files around. The thing that is that slows down our process the most with any companies is having relatively clean and up-to-date historical financial information. So, for example, if you only do your accounting once a year at the end of the year so you can get ready to do your taxes, and you can't tell us how the business has performed from January through July of this year, it's going to be really hard for us to fund you. If you've got regular and relatively consistent financial statements that you're making, and you've got an outside bookkeeper or an inside bookkeeper or a CFO or whatever that's preparing those on a regular basis and doing stuff, we're probably good. We like to see things that are in accordance with generally accepted accounting principles. That's always good. But frankly, we completely understand that these companies are small businesses, and they're doing the best they can to try and make accurate financial statements. And as long as they're consistent, we're really pretty good with that. We look at companies that do cash accounting and do accrual accounting, and we do not require audited financial statements.
And the follow-on financing, how does that work once you've sort of been through that initial process?
Yeah, so the first financing is typically about a month and goes through all that information I just said, as well as obviously the legal process to get the documents all done. When we do a follow-on, it is dramatically shorter. It is a significantly truncated experience. What typically happens is this. Let's say it's 5 months after we've done an initial funding for a company, and the entrepreneur comes back and says, hey, I did an initial loan for $200,000 with you guys. I'm now kind of thinking I really want to hire a couple more salespeople or whatever it is, and I'd really like to look at another $200,000. What would that look like? Now, sometimes if the company has basically got the same sort of profile as they did before, in other words, same kind of revenue level and things like that, a lot of times it's basically just sort of doubling up the loan, which is easy. If the company's grown quite a bit, a lot of times we actually will structure the loan differently because as you grow, we obviously need to take a smaller percentage of the revenue to get the same type of payment. So in effect, as you grow, the money's kind of cheaper from us in a way. And so we'll then basically, the entrepreneur says, hey, I would like another $200,000. We give them a proposal and say, how about this? We kind of go back and forth and make sure it fits their needs. That usually takes a couple days because at that point in time, you understand the loan. We understand you. We know your history. We understand the business a lot better. And as soon as we sort of have a meeting of minds on the major terms, we draw up a 2-page amendment to the existing legal documents, and we typically fund from sort of first phone call to funding is about a week. So it's a really fast process. It's legally very cheap, and we use the existing legal documents except for a 2-page amendment.
Great. Well, it's 11 o'clock, so I think we might call it quits. So thanks, everyone, for attending today. We appreciate your interest. We will be sending out an email with a copy of the presentation and also a recording of this webinar. Plus, also, we've included a calculator that you can use just to play around with and see what you might qualify for in terms of a revenue loan from us before you started a sort of a formal application process. So feel free to reach out and ask any further questions you might have. We love talking to entrepreneurs. So good luck, and we hope to talk to you again in the future. Thank you.